Hello, my name is Dora from Grace Certified Accountants. Welcome to today's video, what you need to know about property and tax. Whether you're considering property as an investment or already own one, understanding the tax implications is very crucial. So let's dive in. Property investment can be a very lucrative business. Whether you're looking to buy, renovate and sell to make a profit, or whether you're looking to generate a regular income, property investment could be very profitable. However, one thing to remember is that any income generating model comes with tax. And that's what we need to look at today. First of all, let's look at self-assessment. What is self-assessment? Self-assessment is a way of declaring your income that you've earned through property or any other source to HMRC. So if you own a rental property, which is not your primary residence, and you've earned more than £1,000 in the year, this has to be declared to HMRC by way of submitting a self-assessment tax return. And if you've sold a property which is not your primary residence, this has to be declared via capital gains tax return to the HMRC by way of submitting a self-assessment tax return. So what if you own that property with your spouse or your civil partner? If you both earn income from the rental property, by default, the share is split at 50-50. And if the rental income is more than £1,000 each for the year, then both of you must register for self-assessment and submit a self-assessment tax return. However, if one of you is a higher rate taxpayer, let's say, for example, they're on the 40% tax band or the 45% tax band, and the other one is on the lower rate tax band, the 20%, then it could be advantageous for you to change the split from 50-50 to a different split, whether 90-10 or 60-40, whatever it is. But this can only be done by way of submitting a deed of declaration and a Form 17 to HMRC to change the split from 50-50 to a different split. Like I said, this is advantageous when one of the partners or one of the spouse is on the higher rate tax band. Now, should you buy a property as an individual or as a limited company? Well, there are different pros and cons depending on your specific circumstances. Let's look at some of them. Stamp duty tax for a company is high. As an individual, you pay tax all the way up to 45% depending on what your other income is or your current tax rate or current tax band. Whereas as a limited company, the business will pay corporation tax at 19%. It could go all the way up to 25% if the profits are £250,000 or more. However, if the profits are at £250,000 or less, then the corporation tax rate is 19%. Whereas as an individual, if you're a higher rate taxpayer, maybe on the 40% tax band or the 45% tax band, then your tax will be considerably higher. Companies can claim full mortgage interest relief. However, as an individual, you only get 20% tax credit. And also there is the ongoing administrative costs. If you're a limited company, the limited company must submit year-end accounts, corporation tax return, and other administrative tasks, and maybe have an accountant to do those tasks. So those are ongoing costs. When as an individual, all you need to do is submit a self-assessment tax return and declare your rental income on the self-assessment tax return. Whereas with the company, there's the ongoing administrative costs. And finally, there is flexibility. With limited companies, there's flexibility for reinvestment and scaling your property portfolio. Whereas as an individual, it might not be as lucrative or as straightforward. Now, let's look at if you decide to sell, you have a property abroad and you decide to sell that property. Well, if you own a property abroad and you're a UK resident and domiciled in the UK, meaning you live here, you pay your taxes in the UK, but you have a property abroad that you've decided to sell. Well, first of all, you may have to pay capital gains tax in the country where the property is situated. However, even in the UK, you must submit a self-assessment tax return and declare that income from the disposal of the property by way of submitting a capital gains tax return, SA 108, and also declare the foreign income that you've received on the SA 106. There is a process that must be followed when you've sold a property abroad and you live in the UK. However, if there is a double tax agreement between the UK and that country where you've sold your property, then you may be able to claim your capital gains tax relief. But this can only be done after all the right paperwork has been submitted to the HMRC. Property can be lucrative, but also can be very complex. It is quite complex, and expert advice is advisable. So if you have a property or thinking about investing or growing your property portfolio and you have questions, feel free to get in touch with Grace Certified Accountants, and we'll be happy to give you expert advice and guidance to help you ensure that everything is on the right track, because HMRC, they aren't forgiving when mistakes are made. So feel free to get in touch. Thank you so much for watching this video. Please remember to like, share, and download, if this information is quite useful. And remember to subscribe to our channel. I'll see you again soon. Thank you and have a good day.